While electronically transferable money started as far back as the introduction of the telegraph that allowed for wire transfers between banks and between countries, digital money really took off only as the internet grew. That brings us to where we are now if we need to move value electronically or over the internet. The most common way of moving money is still to use the legacy financial system, not only for personal transactions, but for the billions that are moved around the world every day for commercial purposes. Credit card companies and their network of merchants are also extremely well developed. Visa, MasterCard, and American Express, among others, are pretty much the de facto method of B2C transactions over the internet, with robust networks and widespread acceptance. However, for a business to be accepted as an authorized merchant for the credit card company, there's still a process that requires financial approval by the card company before they can accept that card. And if you want to accept more than one of Visa, MasterCard, Amex, or any of the major credit cards, you need to repeat that process for each card company, which may be too onerous for small businesses. Lastly, for individuals looking to transfer value electronically over the internet to another individual, direct credit card transfers won't work as individuals cannot receive payment directly from a credit card. This is where digital payment processors have stepped in to help facilitate. Companies such as PayPal, Venmo, and Stripe offer a channel for small businesses and individuals to either use the traditional banking or credit card to transfer value. However, it's still based on one or both parties having a bank account and/or credit card set up. Additionally, these payment processors charge a premium over the fees that the credit card companies already charge to compensate themselves for their efforts. In the past 10 years or so, we have seen apps become more commonplace as a means of transferring value electronically. Alipay and WeChat Pay started predominantly in China, and other entrants such as M-Pesa, GrabPay, and GoPay have taken off, usually in developing economies, where you're more likely to see people who are underserved by the legacy financial system. And as the same population has gotten more ready access to the internet via smartphones, these apps have taken off as a stopgap to fully digital money. Major smartphone makers, such as Apple and Samsung, have also come out with their own versions of these apps, called perhaps a bit unimaginatively Apple Pay and Samsung Pay. One other interesting development has been micropayments and private currencies. Examples of these would include loyalty points, say at your local grocery or department store, that you can redeem for products and services. The same concept holds for airline or hotel travel miles or credit card points, and even in-game currencies for online games, like V-Bucks for Fortnite. While these private currencies have a limited acceptance, it demonstrates how decentralized finance may work to a certain degree. Regardless of whether we talk about traditional banks, credit cards, digital payment processors, digital wallets, or micropayments, the fact remains that all of these methods still require permission and centralized ledger keeping. They all still require both parties in a transaction to rely on a third party, therefore still remaining trust-based, and liable to the problems of a single point of failure, censorship, and corruptibility